Hey guys, how's it going? Welcome back. In today's video, we're going to be taking another look at topic 6, the impact of global events and ethics. However, within this part 2 video, we're going to be focusing on the global economy. As part of the video, we're going to be looking at the global economy, exchange rates, international trade, how we measure economic performance, the financial crisis, in both the UK, the European economy, as well as the current UK economy. So, what is the global economy? We can summarise it as the sum of all economic activity in the national or regional economies of which it is composed. So let's focus on exchange rates then. When we're considering the global economy, exchange rates can have a massive impact upon trade between nations. They represent the price of one currency when exchanging for another. The value of currencies changes continually due to the demand for and supply of certain currencies on international markets. We can see from this graph the Great British Pound versus the US dollar has changed dramatically over the years. Now we're looking at about $1.2 to every pound. However, back in the late 2000s, for example, it was over $2 for every pound. This means that now, when comparing to the late 2000s, we are getting less dollars for every pound. This means that when importing from the US, having to pay in US dollars of course, nowadays it will become more expensive in Great British Pounds compared to the late 2000s. Indeed, the best time to go on holiday in terms of exchange rates to the US would have been the late 2000s because we would have got more dollars to every pound we exchanged. And you can see here the impact that it would have on indeed exporting and importing. Importing from the US would cost us more in Great British Pounds today than the equivalent back in the late 2000s. Exporting, however, to the United States would be cheaper to the companies within the US purchasing from us today than it would have been back in the late 2000s. So what might influence exchange rates then? Well, in 2022 to 23, the UK has endured high inflation. This has led to the Bank of England's Monetary Policy Committee to increase interest rates in an attempt to reduce inflation levels. This has led, of course, to an influx of foreign investors because the interest rate in the UK is that much higher than in other countries. It has led to foreign investors depositing money in UK financial institutions. We call this money, which moves between countries seeking for the highest interest rates, hot money. This has therefore led to increasing demand for Great British Pounds. If there's an increasing demand for anything, it pushes up its value. Let's look at international trade, and in particular free trade next. So what are the benefits of free trade? Free trade being, of course, free trade without protectionism measures between nations. Well, free trade enables countries to trade with other nations without protectionism measures. These make their produce uncompetitive when compared to other markets. It also allows countries to purchase goods and services from other nations, which it may not be possible to produce domestically, or it may not be cost effective. How does free trade benefit financial services institutions then? Well, there is of course the opportunity to raise finance on international money markets. This opportunity to raise finance may be significantly cheaper than raising finance within domestic economies. There is also the opportunity to enter new markets, thereby increasing the potential for profits and subsequent returns for shareholders. How does free trade benefit financial services consumers then? Well, they have a greater choice of financial services, but also there is the potential for cheaper financial services too. As we mentioned earlier, for financial services institutions, they can raise money on international money markets potentially significantly cheaper. They might also be able to enter new markets, thereby increasing the potential for profits. This means that potentially, not guaranteed, they might pass these savings on to financial services consumers. What about the WTO then? Well, what is the WTO? The World Trade Organization is an international organization which deals with global trade rules. It has currently 164 member countries. Its role is to ensure that trade flows as smoothly, predictably, and freely as possible, partly by reducing protectionism measures. These are measures that economies around the world, countries put into place in order to protect their domestic markets. The WTO has tried to eradicate these protectionism measures to ensure that world trade flows freely. So what protectionism measures are we talking about? The three we're talking about include tariffs, quotas, and embargoes. So how do we measure economic performance? One of the measures we use is GDP. What does it stand for? Gross Domestic Product. What does it measure? It measures the value of all the goods and services produced within an economy within a specific time period, usually a year. Why don't imports contribute to GDP? Well, imports have not been produced in that specific country, and therefore we do not include them in a GDP measure. What impact can inflation have on a country's GDP? If GDP does not take rising inflation into account when it's calculated, then inflation will naturally increase GDP over time. For example, if goods and services are costing more each year, then year on year GDP is going to increase, even if the same number of products and services are produced in a particular economy. Therefore, we can also use the measure of real GDP. And real GDP takes into account inflation and is modified to reflect the level of inflation. This graph is taken from Wikipedia and shows the GDP per capita of a number of different countries. You might wish to pause the video now to have a look at it. As you can see, the estimated GDP per capita, which essentially is the GDP divided by the number of people within that country, is very high in certain countries around the world. Luxembourg, Ireland, Singapore, Liechtenstein, Qatar, Monaco and Macau forming the top of this list. So, what is meant by GDP per capita? As mentioned, it is the GDP divided by the number of people within that economy. Why might GDP per capita be misleading when used as a measure for living standards? Well, within a particular economy, there will of course be those super wealthy people, whereas there will also be people who potentially might be living in poverty. If there was a particularly high number of super wealthy people, it actually might increase the GDP per capita significantly, thereby not actually representing the living standards of the vast majority of people. What is a capital good? Well, a capital good is a good that has been produced in order to create and produce consumer goods, i.e. consumables. A consumer good, of course, is a good that is consumed by you and I, consumers, on a day-to-day basis. Of course, capital goods, if produced, might reduce GDP in the short term. The reason being is because capital goods only produce other consumer goods. And in fact, if you purchase or produce capital goods in the short term, then you're not producing as many consumer goods which will be sold to the end customer. That, of course, however, means that if you've got more capital goods in the future, then GDP might increase in the long term because those capital goods can increase the production of consumer goods in the long term. So, let's look at the financial crisis, and in particular regards to the UK economy. The uncertainty that followed the financial crisis of 2007-8 led to the credit crunch. Banks severely cut back on lending to each other and to customers. This led to a steep decline in economic activity and to economic recession. Which, of course, if there's no economic activity, businesses are not investing, and of course sales are depleting, this means there will be rising unemployment. The high level of public sector debt, which existed pre-financial crisis, became even higher after the bailout of the banks and subsequent recession. The government cut public spending and increased some taxes. Of course, the massive costs of the bailout, whilst also having to service public sector debt, meant that the government became a bit short of cash and therefore cut their spending and increased taxes. This became known as austerity. Initially, austerity contributed to a worsening in the unemployment situation and fueled a vicious cycle. You can see on the screen now the vicious cycle of lending, spending and unemployment. Firstly, banks, fearful of default, lend cautiously and only to creditworthy customers. This means that individuals and businesses cannot get finance to spend money on consumption and investment. Individuals do not spend money, so the demand for goods and services falls. Firms do not spend money on buying new equipment and opening new branches, so do not create jobs, and firms make cutbacks, including making staff redundant. This means that unemployment begins and people fall behind on debt repayments, of course fueling the vicious cycle. What about the effects of the financial crisis on the European economy then? Well, the financial crisis put the euro under considerable pressure as some of its members struggled to pay government debts. The European Union witnessed rising unemployment, and in November 2014 unemployment stood across the EU at 11.5%. However, for some EU member countries, figures were even higher. Within Portugal, within Italy, Ireland, Greece and Spain, unemployment was considerably higher. In Greece, the Greek government had borrowed large sums of money on the international markets in the early 2000s to fund an ambitious expansion of public services. However, the effects of the global financial crisis meant that the country could no longer raise money from the financial markets, and it was consequently in danger of defaulting. In fact, unemployment levels went to a record high of 27.9% by July 2013. The Irish people suffered a similarly significant economic crisis. A collapse in the property and banking sectors brought the country to the edge of bankruptcy, and it had to be rescued by loans from the EU, the IMF and the UK government. Spain, Portugal and Italy also did not fare well. In Spain, unemployment reached 23.9% by November 2014. In Portugal, unemployment hit a rate of 17% in 2012. And within Italy, 13.4% unemployment rate in 2014 was lower than that of other problem countries, but again, youth unemployment was a serious and growing problem, and reached 43.9%. So let's have a look now then at the current UK economy. Many years on from the financial crisis, how has the UK economy fared? We're going to be looking at the effect of economic factors on the UK economy, and in particular, personal finances. Firstly, let's look at the effect of high inflation on personal finances. We can see here, this infographic shows that the UK inflation rate was at its lowest point since February 2022 at the end of 2023. But that doesn't tell the whole story. In fact, from 2013 we had relatively stable inflation, around the government's target of 2%. But at the end of 2022, it rose to over 10%, which essentially meant that products and services, on average, were over 10% higher in cost than the previous year. This, of course, meant that for personal finances, people's disposable income was significantly stretched because of the high cost of goods and services. This might have meant that they spent less on discretionary expenditure, which meant that certain businesses might have struggled to have as many sales as they had previously. It looks like inflation is coming down. As you can see here, July 2023, it was at 6.8%, but it is still significantly higher than it has been for the previous decade. What about the effect of high interest rates on personal finance then? This information, taken from the BBC and last updated in the 21st of September 2023, saw the fact that interest rates were very, very high compared to the previous 14 years or so. It stands currently at 5.25%. Of course, that is set by the Monetary Policy Committee of the Bank of England. However, since 2009 at least, it has been below 1%. Very low interest rates will encourage people to borrow more because, of course, their borrowing is charged at a lower interest rate, and it will also encourage movement within the housing market. This, of course, means because there's very low interest rates, people might be more encouraged to move house because they can lock in a very low interest rate on their mortgage. It also means, however, that there's less incentive to save money. If the interest rate is very low, savers will have less incentive to put money into a savings account. This might have encouraged people to 1. Spend their money more, or 2. Look for alternative investments. Of course, since late 2022, the interest rate has climbed significantly. Now at 5.25%, which is equivalent to back just before the financial crisis of 2007-2008, now, because it's so high, this will encourage people to save their money to a greater extent, whereas also borrowers, people who have lending, will also have to spend a significantly higher proportion of their income each month on servicing their debts. This will mean that they'll actually spend less on discretionary expenditure, thereby causing certain businesses to have less income. What about the effect of personal debt then? This, twinned with interest rates, will have a significant impact upon people's personal finances. We can see from the red columns that unsecured borrowing per household took a bit of a dip following the financial crisis, but has continued to increase over subsequent years. The source of this was the Office for National Statistics, and of course, if there's a higher level of unsecured borrowing in each household, then there's a greater amount of income which has to be spent each month on servicing that debt. This means that households have less disposable income to spend on discretionary expenditure. So what about the effect of a volatile UK stock market? This graph shows the volatility in the FTSE 100 over the last year. We can see it has fluctuated between roughly around 7,200 points and 8,000 points, but has no significant pattern. Because there's volatility in the market, potentially caused by certain wars around the world, this might mean that financial services consumers might look for more certain investments. Potentially, savings accounts might fulfill this criteria. It could be general savings accounts, notice savings accounts, or indeed ISAs, ISAs. Individual savings accounts are of course tax-free and therefore might represent a straightforward and less risky investment compared to putting one's money into the UK stock market. However, make sure you hit that like button and smash that subscribe button to be notified when future videos will be released. Future videos in the lead up to the exams will include case study reviews as well as model answer videos. The link on your screen will take you to the next video detailing part 3 of Unit 6. Make sure you subscribe to the channel to be notified when future videos are released.